Welcome back. In our top business story, the UAE's non-oil foreign trade continues to grow. Official data from the first 5 months of the year shows. According to the Federal Customs Authority, the FCA, non-oil foreign trade grew 24% between January and May compared to the same period last year, to now 370 billion dirhams. In absolute terms, that's an annual increase of 71 billion dirhams. Imports were up 22%, while exports witnessed an astounding growth of 41%. According to the FCA, these growth rates reflect the UAE's strong economic recovery. By the way, Dubai accounts for around 3/4 of the UAE's total non-oil trade, while Abu Dhabi accounts for almost all of the country's oil production. Dubai has many mouths to feed. According to press reports, the emirate therefore imported 4 million tons of food products in the first half of the year. That's nearly as much as for the whole year of 2009, when Dubai imported 4.3 million tons of food. Last year, that amount grew to 6 million tons. Again, the first half data shows that Dubai imports more food than it exports, as they amounted to only 3 million tons. According to the Dubai municipality, there are currently over 20,000 registered food items being sold all around the Emirates supermarkets. 335 companies trade these goods, which are imported from nearly every country in the world. The UAE's hotel managers are happy about this Eid season's booking numbers, according to press reports. The region's hotels enjoyed a significant boost in business this Eid compared with last year. Industry experts say, as this season, the holy month of Ramadan, took place in August, which is typically a slow month for the tourism industry. During Eid, however, tourists from across the world returned to the UAE, also because business activity picked up again after Ramadan. This all resulted in surging hotel occupancy levels in the past week. Increased concern over the state of the world economy is trickling down upon the Gulf region's markets again today. Stocks fell on their first trading day since Tuesday. Here's an overview of the region's equity markets. And in our world business news, stock markets around the world are in for a volatile week as recent data points to a slowdown of the industrialized economies. Despite the US celebrating Labor Day on Monday, the economic data calendar is packed this week. Both the European Central Bank and the Bank of England will hold their policy meetings on Thursday. The Fed's economic outlook, labeled the Beige Book, will be released Wednesday, as well as the ISM index on Tuesday. The most recent data to disappoint the market and to again raise fears of a double dip was the US August jobs report on Friday. The world's largest economy added no jobs, and the unemployment rate remained at a worrying 9.1%, as employers were paralyzed by Washington's debt debate, Hurricane Irene, and Europe's continuing debt troubles. Australia's economy, especially the manufacturing and retail industries, is under pressure as households keep a firm grip on their wallets, and the high Aussie dollar acts as a handbrake for exports, Treasurer Wayne Swan said in his weekly economic note today. There's no doubt there are pressures in the Australian economy, especially after the country's currency's strong rally against the US dollar, Swan said, according to Bloomberg. Despite the cautious comments, second quarter GDP data, which will be reported on Wednesday, is again expected to show an expansion. In Q1, Australia's economy shrank 1.2% as the devastating floods hurt many export industries, especially the mining sector. However, in the past month, mining picked up again and is forecast to have boosted second quarter business activity. Speaking of business activity, Brazil's boom is slowly fading. The South American country's economy slowed in the second quarter as the industrial and farming sectors began to feel the effects of the weaker global outlook. Gross domestic product in Latin America's largest economy grew only 0.8% from the previous quarter after 1.2% expansion in the first 3 months of the year, the Brazilian statistics agency IBGE said last Friday. Especially agricultural output, followed by the sale of industrial products, fell sharply. Reason being that the Brazilian companies are struggling with high interest rates and a strong currency, the real. which has made exports less competitive globally and led to a flood of imported products that are cheaper than locally manufactured goods. Before we go, here's a quick overview of the oil, precious metals and currency markets, and after that we have the day's sports news for you.